Thank you. At this week webinar, what we're going to talk about is about the stock market and basically how to trade in stocks, not only in binary, but in general as well. As always, if you have any question, feel free to ask at the chat below. And let's just start. Before that, let me just tell you that this webinar is going to take between 30 minutes to 35 minutes. That you will be prepared. Basically, let's just start with the event of this week and next week. I'm guessing all of you already aware of that. Next week we're starting the American and European earnings season of the stock market, and as always we open it with the banking industries of United States. I want to talk a little bit about those stocks, but we're going to do it in a different way. We will talk about them at the end of this webinar, not at the beginning. And the beginning, basically because I believe that we need to know several things. This webinar is for beginners, and there are some things that you should know regarding the stock market before we will talk specifically regarding several stocks. What I do want to talk about is, if all of you were attending in the webinar last week, we talked a little bit about the economic calendar and how to trade with the economic calendar, and we saw several events in the market. The event that I want to talk about is the United States non-farm payroll, or basically the unemployment change in United States. We know that it's coming out tomorrow at Friday at 12:30 GMT, and I can tell you that this is one of the most important events in the market. Okay, this event basically affects the United States dollar and of course all the major indices of the stock market and the bonds market in United States. Well, this event, again, as I said, is at 12:30 GMT tomorrow. And the way to trade in this event, there are two ways. One, of course, before the event, according to speculation in the market, to the result of the event that will come out, we always see a strong volatility in the market before the event and after the event. But this is for some sort of traders. The second way is after the event, how we use the economic calendar that we talked about in the last session. Basically, we're waiting for the result, and then if the results are bigger, more than 10 to 15% the prediction of the market, or the other way around, less, we're going to open a position according to that movement. But just keep in mind that the position will be in short term. And when we're talking about short term, we're talking about 15 minutes to 30 minutes, no more and no less, because there are some other effects in the market that could affect that trade as well. Well, as I said before, regarding the stocks, in this brief we will talk later, and let's start this webinar. Okay, just a second, if you had. Okay, so basically when we're starting to talk about stock, the idea behind a stock is, what is a stock? When you purchase a stock, the first thing that you do, basically, you buy some sort of percentage of that company. So if the company profits and profit more, the stock price goes up, and if it loses, the stock price goes down, and that exposes you to that company. Now, why do we want to buy a stock or open a position, a call position in binary or in general in CFD, to open a position on a stock? Two things. One, we either can expect something called capital gain, which basically means that the price of the stock will go up. The second thing that we could anticipate is something called dividend. Now, when you buy a dividend, when you receive a dividend from a company, it's basically that the company give you some percentage of their profits. And by that, of course, the price of the stock go down immediately. For example, if a company stock is $10 a share and it gives you by dividend $1, the price in the market will automatically be $9, but it wouldn't affect you. It means that you wouldn't lose several capital regarding the stock that you own. That's just, you will receive that cash flow in your balance. So basically, the important thing regarding stock, and the main difference between stock and bonds, I don't know if you're familiar with bonds, so let's just talk a little bit about the bond market. I know that a lot of people familiar with bonds since the crisis at 2008, when we had a crisis within the bonds market because people couldn't put collateral for the bond market, and that affected immediately on stocks as well. And from that, everybody knows the story. A bond basically is IOU. We have bonds that issue by governments, and we have bonds that issues by companies as well. The main difference when we're looking at bonds and at stocks is, first of all, countries don't give you stocks. You could buy the currencies and then you would be affected like a stock, but it's not basically the same. Bonds have a fixed rate. Okay, for example, a company can issue a bond that will be traded and that bond will have a rate of 2% every year. That's what you will earn. Now, what's the difference between a stock and a bond? First of all, stocks are a little bit more dangerous. How is that? If a company goes bankruptcy, we have some problems with the company, the first thing that goes down is the stock. The stock price will get down, but bonds will go down as well. But by the end of it, if there are very, very big problems with that company and the company went bankruptcy, people who holding stocks wouldn't get nothing. That's usually what happened. But the people that own bonds will get some of what they deserve. So if you're not a risk taker, you probably will buy more bonds, less stock. And if you love risk, you will probably buy more stocks. Now, the main difference, as I said before, regarding the interest rate. So if I buy a bond, let's just set an example of the market of a company like Apple. I'm guessing everybody familiar with it. If you bought the stock of Apple since the beginning of the year, you would have profited something between 30 to 40%, which I'm guessing that everybody over here will agree with me that that's kind of plenty. And on the other side, if you would have bought the bonds of that company, you would probably profit less than 1%. Okay, now let's keep in mind, we bought the same thing of Apple, just one bond and one stock. So in that case, it shows us that it's a lot more better to hold the stocks. But when things go bad, that's the other way around. So that's the difference between that. A third thing that I want to talk about in the market is the major indices that we have. First of all, those indices that we will talk about are regarding stocks. I'm guessing a lot of you heard around the news when, depend on the country exactly that you are from. If you're from England and you hear England news, you will hear about the FTSE. In United States, we will hear a lot about the S&P 500, the Nasdaq, or the Dow. And in Germany, for example, we will hear a lot about the DAX. So when we hear in the news in general that the stock market is down 20 points, 15 points, and etc., in United States, usually they will talk about the S&P 500. Now, why do I start with the S&P? The S&P 500 represents 500 of the biggest companies around the world that traded in United States. Okay, so when we look at the market in general, when we have problems in the market all around the world, or we have good news, the S&P is one of the first indices that get affected. So it's some sort of an indicator for the market to tell us what exactly is going on. The second one that I usually like to refer in when I'm trading, I'm looking at is the DAX at Germany. The DAX represents 30 of the biggest companies. I'm hoping that everybody hear me well. If not, feel free to write a message over here. Well, as I said before, the main difference between them is that the DAX is traded at Germany. And as we recall, a lot of the time when we have traded in Germany, the United States market is off and the other way around. The main difference is that the German DAX built only from 30 of the biggest companies in Germany. So therefore is a lot more volatile if you want to trade than the S&P. For example, we don't usually see the S&P moves more than 1%, either up or down. So let's just summarize everything that we talked for now regarding indices and stocks. The most important things that we will realize from what we talked about is that when we take in those assets, when we're looking at the stock, just to buy a stock like Facebook, Netflix, Amazon, and etc., this is the volatile asset over here. It's not a surprise if a stock, just take a look at yesterday what happened when a huge company like Tesla went down more than 7%, and right now in the aftermarket they are down more than 2%. Now, this is a huge company, more than $200 billion profit worth, sorry. And those numbers are huge when we understand it and just trying to figure out what's going on over there. And after that, in the volatility range is the indices. Indices don't tend to move that much, but on the other side, bonds don't tend to move at all. So they are the less risky way to invest. If there are any questions, I will be glad to take them. If not, let's carry on. Well, as we're talking right now regarding stocks, the first thing that came in mind is how do I base my decision whether to open a position or not opening a position regarding a stock. Now, the first thing that we can do is something called a technical analyst that we talked about a little bit in the previous session, and we will talk about in the next session, the next webinar that we will have next week. Is to invest regarding that, basically to analyze the chart of the stock or using several indicators in the market to base our decision. That's not what we're going to talk about today. Today we're going to talk a little bit about fundamental and basically how to analyze the numbers behind those companies. Keep in mind, as I said in the beginning, from next week we have the earnings seasons, and there we will have new numbers regarding all the companies. So the first thing that we want to talk about is something called EPS, or basically earning per share. Now that's the earning of that company. Now let's take an example in our mind. If I will tell you right now, okay, which stock would you prefer to buy? Company A, which profit $10 billion, or company B, which profit $1 billion? Now, I'm guessing some of you automatically answer, I would probably prefer company A. But I'm hoping that some of you ask, look, we can't really know. We need to know the value of that company. Okay, what's important for us is the value of that company to know basically how we're going to profit from it. And for that, we have EPS, which stands for earning per share. Basically, every earning season, all the companies will report their profit, how much they profit per share, not the general profit, but only per share. Now, that's not enough for us to really know the numbers behind the company. And for that, we have something that's called P to E ratio. Now, how does it work and how do we calculate it? Let's add an example over here. Let me just write on the screen. If I'm telling you that a company profit it's supposed to be a $2 every year. Okay, in the earnings season, the company tells me, look, every quarter I'm profiting $0.50. Now remember, we need to a little bit predict the future over here, because when you do it and the company in the latest report told you, look, we profit EPS of $2, of $0.50 this quarter, when we analyze it, in our mind, they're going to profit the same. Now, usually in the market, we always expect more and more and more from a stock. You don't expect the same profit or even the profits to go down. So we need to remember it. Now, in this example, if I'm telling that the company profit $2 yearly and the price of the stock is $10, so the P/E ratio of that company is 10 divided by 2, which stands for 5. Now, what that numbers tell us, let's think a little bit about it. If I buy a stock at $10 a share and the EPS of that company earning is $2 per share yearly, that means that basically if I will buy the stock at $10, I will expect it will take me 5 years to get my investment back, to do 100% over my investment. Okay, because if the company is worth, if the stock price is 10, first year it will profit 2, the price will be 12, etc., 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 14, 16. By 5 years, it's going to be 20. So by that, I would have done 100% over my investment, or I will receive some of that capital in dividend and etc. But in general, in 5 years, I will expect to do 100% over my investment. Now, let's keep in mind that this way of calculation, I'm going to show you several examples right now, is more for old companies, as I like to say, companies from the banking industry, companies like Intel, a little bit less for companies like Google and Facebook and etc. I will show you later exactly why. But this is for companies who have a cash flow, that we know that the profit will keep on growing. New companies that we always expect new things, to innovate in new things, and basically the number will be a lot bigger because the profit is kind of low. And more than that, a lot of people expect huge things from those companies, which affect the stock price and keep getting him up. Let's stop with this and show several examples. First of all, the screen that we're seeing right now, taken from a site called Yahoo Finance. I'm guessing a lot of you are familiar with. And this is basically the way that stock's looking over there. Now, let's just go one by one what we're seeing over here. Everything will be clear. This is basically the stock price, 64. Over here, the 64.8, as you can see, it plus almost 0.9% up. This is the pre-market or after-market. There are a lot of times when the American market is closed, but still we have off-the-market trades. People could buy that stock and sell it. So this is the price. It could help us. A lot of times, just a second, I will go back, Sabrina, but by the end of this presentation, there will be a part of questions. Okay. I can just say about the P/E ratio, I'm going to talk a little bit about over here as well. If still it's not clear, I will tell everybody about it. As I've been, a lot of people, you can purchase stocks when the market is closed as well. We will see that price changed a lot in the earnings season, for example, because in the earnings season, we have the reports of those companies. Now, the way that the American market works is that the results are not during the trade. So we wouldn't have at the middle trade, we will see stock like Apple going up 5%, then down 3%, then up again, and then down, until people starting to realize exactly what happened in the report. Let's keep in mind that the earning report is usually between 200 to 400 pages long. So you could start read it and then all get confused. Okay, it should go up, it should go down, the profit is like that, because yes, we have the EPS of that company in that report, and it could tell us a lot about the company, but there are a lot more numbers that we need to digest to understand exactly what's going on over there. Regarding the future of the companies and etc., it's very, very flexible regarding every company. So let's go back over here. The second thing that's important for us is the market cap that we see over here. This is the value of that company. Basically, it's the price of the stock divided by the stock's number. We can see that the company, which I'm guessing all of you familiar with, the bank Citigroup Bank in United States, and his market cap is almost $180 billion. That's on that side. And you have a P/E ratio of almost 13, which tells us that if the profit of that bank will stay the same, it's going to take 13 years for us to do 100% over our investment. Now, how it could help us? How will P/E ratio help us decide whether we should buy the stock or not? Now, some people could say, 13, I know that interest rate right now is around 0, and it's probably a good thing. We'll do a lot of money very, very fast. Now, that's not so true. First way, we need to compare the P/E ratio to the same industry P/E ratio. For example, as you can see below, I already written for you, the P/E ratio in the banking industry is around 17.8, which tells us that the P/E ratio of Citigroup is quite low. It's good. It means that the stock price should go up. So this is the first indicator that yes, we probably should buy that stock regarding P/E ratio. A second way to work with it is to analyze the P/E ratio of the history of that company. Okay, those are the two major ways that we can work with those numbers. Now let's take a look at several examples of that number around. We have a company called GE, General Electric. And you can see that the P to E ratio is a little bit above 27, almost 28. And the usual technical logic firm average is 25, which tells us that we should probably wouldn't want to consider buying the stock. And on the other side, I wouldn't consider shorting it. I wouldn't consider selling it, just because of the difference between the market average and the GE number are not so big. That's the main reason regarding that. Let's take a look at several more examples just to get our heads around it. A lot of people get confused. First of all, Alphabet is Google. They changed their name. The second thing over here that is quite nice to see is that the market cap of Alphabet is almost $650 billion. Now, I can tell you that right now the stock traded a little bit lower than 927, so it's more around 630. But let's just think about the number and what happened over here. In the last few days, Google went down a little bit. Some problems with the company, problems with the market in general. And a company like that lost more than $60 billion in 1 week and the value of that company. And we see those things a lot of times in the market. Now, the second thing over here, as we said, is the P to E ratio that, as you can see, is more than 32, more than 31. Now, before we explain it, let's take a look at another company, which called NVIDIA. I'm guessing not a lot of you familiar with that company. If you have computer and you have kids and they play on the computer, probably you have a graphic card of that company. They worth almost $87 billion, and they produce processors. And now with the intelligence cars that started to come, they are one of the best companies over there. That's why we see that the stock goes up quite a lot. The chart that we've seen over here is the daily chart. If you see that the stock is going down, I can tell you that in 2016, it was the best stock in the S&P 500 in the American market to invest in. Did more than 200%. Disregarding that. But what's more important for me, the reason that we're seeing it, is, as you can see, it has a P to E ratio of almost 50. So it doesn't look that charming. I don't really want to possess a stock that in 50 years I'm going to do 100% over that investment. It's not so smart, in my mind. So why are we seeing it? Why does stock price keep on going up? I can tell you it with another example. A little company named Facebook. When Facebook just issued himself, the audio should be working. So if the audio is not working, I will appreciate it if you will tell me. Okay. Well, as I said before, I can explain it with a small company called Facebook, or it was small. When Facebook's first IPO, the company traded at a P to E ratio of almost 100. And that didn't make a lot of sense to buy that stock. And still people kept on buying. Now, why is that? Because companies like that, companies at the beginning of the way, don't really show profits. And we're not really looking at profits regarding those companies. We're looking at the future. What could have happened? What will happen? And that's important for us to keep in mind. So when we buy a stock like NVIDIA, when we analyze that stock, we're not asking ourselves, okay, how many processors did they sold last quarter? Then I will know about the future. What we do, we're asking ourselves, in the future, how the sale will be, how the profit of that company could be in the future. So those companies, I tend to talk about them more as news companies. In that point of view, well, sorry. And as we talked about before, let's talk a little bit about the earnings season. When we're talking about the stock market, we always need to talk about the earnings season. It's one of the most important times every year. When you're a stock trader, it's a go 4 times a year, and that's enough for us. But we need to keep in mind, first of all, in the next week, we will see a low volatility in the market. It's usually what happened before the earnings season, and even more during the non-farm payroll. People are kind of waiting for the result to get out. What's important is to pick the stock to follow, and more that the way that we want to trade. As I said regarding the non-farm payroll in the beginning, the same things happen in the stock market. when we decide to trade. We could trade after the results are out or before, during our analysis of the market. Now, after the result, there are a lot of ways that we could trade. If we see that the stock is, usually when we have bad news, and the news are not so bad, but the market didn't realize it, we see some aftershock, overshooting in the market, then we need to take advantage of it. Let's see several examples over here. I think it's the best way to understand exactly what we're talking about. The first thing that we see over here, this is one example of the flowers that our company provides to client. This was 1 year ago regarding Walt Disney Company and etc. But what I want to talk about is with those little examples over here. First of all, let me just clarify this little chart that we're seeing over here, quarterly earnings. You can see it everywhere. Basically, what you need to do is to go inside Google, just write down earning reports, in this case Alphabet, and this is usually the first site that you will see, nasdaq.com, and then you will have all the data regarding that company, the date of the next report, the numbers, and more important that the forecast of the market and the effect. Now, when we look at this chart, let's look a little bit about what we see in over here. First of all, we see the forecast. First of all, we see the data, the date of that report. Then we see the forecast of that EPS. And after that, we see the real earning per share. Now, while we're trading, we usually expect that the real earn per share will be a little bit higher than the forecast. If it's a lot more higher, it's better for us. That's not usually what happened. Usually the market is kind of fixed and the divergence is not more than 15%. And basically what we're seeing over here is the effect of those numbers. Like over here, for example, we see that the forecast was 7.24. The actual result was 7.73, which is more than 6% higher than expected, and this is the reaction in the market. Over here, for example, we see that we had bad numbers, not as expected, a little bit less. That little bit less causes a little bit downfall over here at the stock as well. Over here, I can tell you that we can see that there is some improvement in the numbers, but the market expected more, and every time that the report is out, the CEO of that company comes out and talk with the public. And at that quarters, we had several problems. You will see that Facebook as well, next page, we're gonna see it. And that's what caused it. But the easy way, when we analyze companies in the long term, when we're working with EPS, is as long as the EPS are positive and kept on going, probably if we will buy the stock from 1 year and etc., or even less, you're gonna be in profit. And that's the way regarding that market. The second thing that's kind of nice to see over here, what's more nice to it is that I want us to see the numbers behind a company like Netflix. As I said in the beginning, Netflix traded, as you can see, at $150 a share at that point of that report. And we can see that yearly, when we combine all the earnings that we see over here, the profit of the company is less than half a buck. So that means that the P/E ratio is more than 100. And as we said in the beginning, 100 years to buy that stock. And still, when we're looking at yearly chart, it started at $90 and then it reaches 150. More than 60% profit. And still, it have a P/E ratio, sorry, EPS, a P/E ratio of almost 100, which suggests that we shouldn't buy that stock. But basically, what's more important for us, and as I said before about those companies, when we're looking at a company like Netflix, the thing that I'm looking at over here is not how much the company profit, how much it invests, is how many new subscribers that company have. And if they have a lot more new subscribers, that's good for me. Then, okay, probably in the next couple of years, they're going to invest a little bit more. The profit will be down. But by the end of it, when they will decide to change a little bit of why, everything will come back to us as investors. The second thing over here regarding Facebook is kind of the same thing. What's important regarding Facebook, we can see that over here, as we saw in Google, the same thing. We had good numbers, more than 14%, but still the market reacts. This is something that happened all around the market. It's affected all the companies. It doesn't matter regarding their results. I want to carry on that as well. Okay, let's talk a little bit about Warren Buffett. and then we will talk what we expect in next week. I'm guessing almost all of you aware of who Warren Buffett is. We talked a little bit about him in the previous session as well, when Warren Buffett is one of the richest men alive. And now there is something in the market. I usually call it, a lot of people tend to call it the Warren Buffett effect, the Buffett effect. Basically what happens is when you buy a stock and he goes out to the public and tells, look, this is the stock that I own, I believe in that company, a lot of times the stock tend to go up. A lot of people respect his opinion regarding the market. Now let's take a look at the example of a stock that he purchased lately. A company I'm guessing all of you familiar named Apple, and he bought the stock in a total amount of $2 billion. Now, he bought the stock two times. One time at almost $1.2 billion, the second time at $800 million. Now, it's kind of funny every time that I draw it, but the place that he bought the stock is over here at the beginning, and then he bought it around here. Now, if you're familiar with support in the market, when you technical analyze the chart, basically what he said over here, and we saw it, that there is a strong support around 90. He told us, look, doesn't matter what will happen, if the stock will go down to 90, I'm gonna buy it. And we saw it in the market, and we saw it happen in Apple. And by that, as you can see, it's quite clear right now, if you bought a stock at average 2 billion at around 90 bucks, you profit more than 800 million from that purchase. Now let's go back at what really happened in the market. At the beginning that he bought the stock, there's some conversation about problems with Apple regarding the profit, some problems in the future, a lot of competitions. We have a lot of new Chinese companies that we didn't have before that produce good phones at a very, very low price when you compare it to companies like Apple and Samsung. And the market started talking about it. But when a guy like him buy a stock, he affects the stock, and that's exactly what we saw happening over here. Well, that's about that. Let's go back. Just a second. If anyone have any more questions, feel free to ask right now. We will answer them. Well, as I said, we had several things happen in the last few days. First of all, we have the non-farm payroll tomorrow. Just keep in mind, one of the most volatile and important events if you are a currency trader and want to trade in currency. Okay. The second thing, as I said, feel free to write the questions if you have them. The second thing that happened is with a company called Tesla. I'm guessing you're all familiar with it, as we talked about it before as well. Just let's put this chart over here. As you can see, regarding that company, it dropped yesterday more than almost 7.5%. And right now in the aftermarket, they're standing around 220 bucks, more than negative 2%. Now, why is that? What happened? Yeah, we have the earnings seasons. The number of the earnings season are not out yet. But company like Tesla sells cars. If you don't know, electric cars. And the numbers that went out yesterday is how many cars they sold. Now, they sold, everybody, look, we sold 22,000 cars. But the market expected more. Now, I don't know if you're familiar or heard before about Elon Musk, which is the owner and CEO of Tesla. He tends to do a lot of performance. He tends to talk a lot. And in the long term, basically what he said is, look, yeah, we sold only 22,000 cars since the beginning of the year. But in the next year, we expect in 2018 that we will sell 500,000 cars from the Model 3. Now, a stock like Tesla, it's very, very hard to work with. Let's just see the chart over here, exactly what's happening. Now, I can tell you that almost all the major analysts in the market, for example, JP Morgan and Goldman Sachs, yesterday did a little fix on the numbers for that company. They changed it from a target a target price of $190 a share to 180. Now let's think a little bit about it. For something like 1 year, the average price rate, that it's kind of hard for me to show it over here, around here, and the stock kept on going up. So always keep in mind regarding exactly what he's saying, what will happen in the market. There is some sort of a big difference from those numbers to the real numbers in the market. But yes, we could see a very, very strong drop in the company. In my mind, at least, if it will reach, and it's very hard to believe that it will reach around $250 a share, it's a great purchase and a great opportunity for a long-term position. I will consider opening a position at the beginning around 280 or between 280 320. It depends on the way that the stock will trade. Tesla is one of the biggest short stocks in the United States. If you're not familiar with the term shorts, it's like when you open a position of a put, basically you want a stock to go down. And when a lot of people open that position, you have a lot of interest in the market. A lot of people want the stock price to go down, and sometimes they cause it to go down. It's some sort of an effect in the market. And when you have a lot of short seller, it means that a lot of people want the stock to go down. On the other way, when they start losing, they need to close their positions, which will affect the stock to go up as well. So always in the market is kind of a race between the two sides that playing with it. The second thing that I want to talk about is, again, regarding the earnings season and Warren Buffett effect as well combined. As I said, next week we're starting the earnings season, and all the major companies in the banking industry will report their profit. And this is therefore the time to trade on those stocks. And just when we're trying to figure out which the direction that we should do, whether the stock go up or down, but just keep in mind two things. The first thing, interest rate in the United States went up a little bit, and usually all around the market, when interest rate goes up and we have higher interest rate than 0.5%, it's good for the banking industry. The profit of those companies kept on going up. A second thing, as you can see, first of all, second thing, in United States, the Fed allowed all the major banks to raise their dividend payout. And the second thing over there is, as you can see, for example, Warren Buffett said, I'm believing in the banking industries in the United States. I really, really believe in those companies. And for example, we can see just from last year till now, how many more bank stocks he purchased. For example, B of A, Bank of America, is the biggest shareholder over there, almost 16% out of $250 billion. They also have Wells Fargo, a lot of shares, Goldman Sachs as well. Basically, I just don't see why Reddit he have shares in all the major banks in the United States. And let's keep in mind, usually in the market, when we see that the American market when we see that the banking stocks are having good reports, it's kind of starts some sort of a small rally in the market. Usually after we have good results in the banking industry, it's immediately affect other stocks as well, because they are opening that season. I will appreciate if you have some questions for me. This is basically the end of this session. Well, next session we will talk a little bit about technical analysis. From the beginning, how to identify resistance and support points in the market. More than that, we will talk a little bit about how to trade with Bollinger Bands and RSI in the real market, the currency market, less regarding stocks, more for short-term trades, and how to benefit from it in the market. We will talk as well what will happen in the earnings season with the banking industry. That the webinar will be a day before they will report their number. And of course, we will talk about the effect of the latest NFP that will be tomorrow, and the way that we should have traded in and to see exactly what happened in the market. I want to thank everyone. If you have any more questions or something that you can always feel free to talk with your account manager regarding it. Basically, just to schedule a session with our analyst department as well. I want to thank everybody for your time. I hope that you learn a thing or two today. And I wish you a very, very good day as well. Bye for now, and thank you. Good day, everybody. Thank you.